This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Thank you for joining us. I'm Gord Long with GordonTLong.com. I have with me this morning again John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back.
Morning, Gord. Hey, you're looking good on your new high-def feed here.
Well, I can see your pool table, and you're making me envious. We haven't seen your pool table so clearly. Do you get to play often?
That's how I waste most of my time these days. Yeah, I have a man cave here, and that's a good thing and a bad thing. There's a poker table on one side of the room, a pool table in the back, and then my little computer at one end, where I'm supposed to be most of the day. It doesn't always work out like that.
You have some sons, don't you, John?
Two.
Yeah. Well, I'd be envious if my old man had a pool table.
Well, you got to have the right toys if you want your kids to hang out with you.
Oh, that's the secret. That's why we're doing
this. That stays true all the way through life. I'm looking for grandkids now, figuring out what I need to buy for them to get them to come over and play with me.
John, I have up an agenda of the kind of things I'd like to talk about today, but really just about earnings and the Q1 earnings that we're seeing that are starting to come out. We've already seen some scary stuff from the banks, and maybe we'll really focus on the banks, because I think over the next 2 quarters, personally, I believe the bank earnings are going to be a major concern, the non-performing loans and loan loss reserves. What's your feelings on the Q1 earnings? What overall, what do you see happening here?
I think this is hilarious so far. It's earnings season, as you said, and the banks are reporting, and they're reporting really bad numbers year over year. Citigroup's earnings were down 28% year over year, and double-digit drop in revenues, and it's pretty much the same for Bank of America, JP Morgan Chase, Wells Fargo. But the headlines in Bloomberg and other major media outlets are, Citigroup beats expectations. That's the headline, because Wall Street plays this game with their big client companies, where when things are heading south, the analysts on Wall Street lower earnings projections even faster than earnings are actually dropping. So the companies can say, we lost money, or we made less money than we did a year ago, but we beat Wall Street's expectations, and that becomes the headline. So you see all these positive headlines out there for the big banks when the actual numbers are horrendous. At year 7 in a recovery, banks should be reporting phenomenal numbers. They should be reporting blowout numbers, because this is the point in the cycle when lots of people are borrowing because they're excited, and interest rates are down, and funding is cheap for the banks, and so the banks should be doing real well. Instead, the banks are rolling over big time. Their earnings are probably, when all is said and done, they're going to be looking at a low single-digit decline year over year in earnings. And finance at this late decadent stage of American capitalism, finance is the biggest part of the economy. So you can't have banks shrinking and reporting losses or lower numbers year over year and laying people off and pulling back on their lending, and at the same time you have a growing economy. Those two things are mutually exclusive when banks are the biggest part of the economy. And that's what we're seeing now. So the year ahead has got to be rough for the U.S. and for the global economy, just because their biggest players are having trouble now. And there's nothing on the horizon to make it better. There's no big new revenue source for banks out there that's going to kick in 2016 or 2017 and make it all right. It's only going to get worse from here until this part of the cycle plays itself out.
45% of the Dow is financial stocks. So any kind of, and that never used to be that way. In other words, financialization in America is front and center. And so any kind of problems, and we haven't seen issues in the banking sector other than 2008. And we all know the story there. So, but non-performing loans are a major issue because it's the old adage, I think, John. It says, if you borrow $100 million from the bank and you can't pay it back, you got a problem. But if you borrow $1 billion and can't pay it back, the bank's got a problem. And that's what's going on now with the energy sector and the commodity sector, where the banks, where these are high capital intensive industries, banks have leveraged huge amounts of money, leveraged money, and you can see what the price of oil is. They can't pay it. So somewhere in there, the banks have got to start taking loan losses, and they haven't been incurring those before. So it's going to hit the market, I believe, right now.
And this is completely normal for the business cycle. At the peak of every cycle, banking turns down, and then people start looking at the banks and saying, "Oh my God, they lent how much money to this sector? Was it New England real estate or something like that?" And when that sector tanks, it pulls the banks down too. And this time around, it was commodities. Commodities had a huge boom for 3 or 4 years as China borrowed more money than any country has ever borrowed and then used it to basically buy up all the world's commodities. The banks in the West financed a big part of that process. So now they've got all these loans out there. And this is funny too. They gave big commodity companies credit lines, which the commodity companies can then draw on at their discretion, and those lines are still out there. So now you've got the spectacle of these big banks. They're already on the hook for billions and billions of dollars to the energy complex, for instance. But those guys who are in deep trouble can keep themselves alive by drawing on their bank credit lines. In other words, by borrowing even more money from the big banks, and that is largely open-ended. That's got a long way to run before the banks can get out from under that.
I've written extensively about Glencore and all of these large-scale leverage commodity players, and I called them, I think, 5 months ago, as the canary in the coal mine, because of how leveraged they were, and it's only got worse. And the banks are really the ones sitting on the problem here, and they'll hide it. They won't all come out this quarter, but they're out of runway of places where they can put it, unless, of course, commodities shoot up, unless energy shoots up, and they've been buying time until that happened. I have a chart here right now on the commercial lending. Look at the chart showing Deutsche Banks. The stocks have been signaling a serious problem for quite some time. So we know that the earnings from the Bank of America this week, Wells Fargo, are sending problems, but some of these banks, and picking on Deutsche Bank, I think they got more serious issues than we're going to hear about in the short term. And maybe that has to do with the European banks, possibly.
Well, Deutsche Bank, as a big German bank, has lent a lot of money to the periphery in Europe. They basically did vendor financing. Germany did for the past almost decade now, since the introduction of the euro. And basically, they've lent money to Italy and Spain and Greece, which allowed those countries to buy German stuff. So Germany reported these phenomenal trade numbers. They had big trade surpluses and their economy grew and their debt didn't grow very quickly. And that was because they were financing these peripheral countries buying their stuff. Well, those guys can't pay now. The Italian banking system is in crisis. It would implode in a heartbeat if it wasn't being bailed out every 6 months or so. And so German banks are kind of on the hook for that. So Deutsche Bank is suffering from problems in its own backyard. And it's also a big derivatives player. So they've got a lot of, as you said, under the surface problems that haven't come up yet that their behavior implies they're trying to address, because they're laying people off and they're taking big write-downs. And I don't remember what their loss was in the past year from write-downs, but it was huge. It was multi-billion dollars.
Well, enough that they have a new CEO over it.
Yeah. And that's Deutsche Bank. That's the best bank. So let the other banks be correspondingly weaker to Deutsche Bank, and you've got a financial crisis of epic proportions out there. So
they do something like in the area of north of 60 to 80 trillion in swaps. They've got to be on the wrong end of something somewhere. I'm just purely speculating.
Yeah, well, their derivatives book dwarfs the size of their home country's economy. So so the notional value of their risk just from that one sector is bigger than all of Germany. So if they get into trouble with just a fraction of that derivatives book, then it just vaporizes them, and it maybe takes down Germany itself. The worst case scenario with a lot of these things is almost too bad to even contemplate, because we put ourselves in a position where the amount of debt and the amount of leverage wherever you look is an existential threat to the place where it exists, and there's no place that's not like that. You can go through Latin America, and they're in a crisis, and Japan is flatlining while taking on more and more debt every year. Europe has several big problems. We could spend a whole show on each of Europe's problems, and then the U.S., where we're sitting here thinking, oh, we've avoided the worst of the problems. Well, we haven't. We doubled the national debt, or the government's debt, just in the last 5 or 6 years. And we continue to leverage ourselves further and further, dig ourselves deeper and deeper into a hole. And now the banking system is rolling over. So
we never fixed, the world, the banking crisis of 2008. We papered it over in the United States, but we never addressed it in Europe. And where I'm going on that is Lehman failed at 32, 33 to 1 leverage. And but the European banks, on most of them, are north of 50 to 1. And that's published numbers, never mind what I think is realistically going on. So any kind of drawdowns, write-offs, let's assume it's just with the energy sector. There's 2% and you're gone. 3%. So and how does the ECB bail them out? So I think the market is starting to get very concerned. Now we're talking about commercial banks. Look at the investment banks right now with the prop desk, with volatility that's spiking, with low interest. The prop desk, they're laying off right now. Comments on the investment banks?
Well, yeah, there's less M&A going on in the world right now because so much went on before. The energy complex boomed for several years. Commodities in general boomed. And that generated huge amounts of mergers and acquisitions fees for the big banks. Well, that's all drying up. So that part of the big banks is now in contraction. Prop trading is something you could it's arguable that should even exist for a bank. Why should a bank be able to gamble with its own money on its own prop trading desk? And they can do that. Is we allowed the banks to turn into hedge funds effectively. Goldman Sachs is just the world's biggest hedge fund, and so you've got these operations within what are defined as commercial banks in a lot of cases that shouldn't be there. And as interest rates are more and more distorted by governments desperate to finance their own deficits, as you get into negative interest rates or zero interest rates in a lot of places, that makes trading these markets harder and harder because it makes it harder to manipulate the markets. You get all these kinds of weird volatility and relationships that depart from historical norms when you start distorting the pricing structure of money the way we're doing now. And so these prop trading desks that have their black box models that spit out trading instructions based on past relationships don't work anymore. And so you're seeing hedge funds implode, or at least report huge losses. At the same time, the big banks' prop trading desks aren't profitable anymore, and that's basically two sides of the same coin. You can't trade these markets if we're distorting all the old relationships, and you can't manipulate these markets the way the big banks used to do if volatility is spiking beyond a certain point, because then you can't control the markets. You can't take a position over here and then use some guys on a different desk to move the market towards your position anymore, because the markets are kind of off doing their own thing. The falcons aren't listening to the falconers anymore. And that's the kind of world we've created. And it's really inhospitable for the big banks. And they don't know what to do. So they're just laying people off. When in doubt, cut your costs. And the funny thing is that investors are kind of rewarding them for it. Citigroup reports terrible earnings, but says, "Oh, we're going to cut costs really aggressively," and their stock goes up. That's something they can get away with for 2 or 3 quarters. But when people figure out that these cost cuts don't actually keep up with the decline in revenues, and so earnings are going down, when that happens for 2 or 3 quarters, and it's a pattern that people can pick up on, then that's the end of the game for the big banks. They'll just plunge.
John, remember in 2007, 2008, we learned about CDOs, collateralized debt obligations, and we're using CDSs to be able to back them so they were AAA. CDOs. I have up a chart here showing CLOs. These are collateralized loan obligations, and you can see that they're plummeting ever since we came off taper or the end of QE3. So, but what we need to understand is these collateralized loan obligations are being built from not mortgages like we were in 2008. They're being built from leveraged loans. And leveraged loans themselves are really the bedrock that the banks use in investment banking for mergers and acquisitions, for takeovers. So they're highly leveraged. So you need a whole stream of these leveraged loans, which are problematic, to fund CDOs, and you can see, or CLOs rather, you can see on this chart, CLOs are falling off because of the Dodd-Frank regulations that says you need collateral. You got to have some skin in the game. We kind of learned something. And so the banks are finding they got to figure out how to give these guys some collateral so they can sell them the leverage loans. And now they're playing, I won't get into the detail, all sorts of games to pass them equities to get around the 5% rule. But this is a serious issue, and it's impacting profits in the bank. That's why I'm bringing it up. This is the bedrock of how they don't make money lending you money anymore. They make money on all these leverage loans where people are leveraging up almost no equity to buy something with almost no interest to skim off pieces of it, or in terms of M&A. Comments on that? What do you see?
Yeah, well, back when banking was a legitimate business, banks made loans. Yeah, not really that long ago, basically. But banks would lend money to their customers, and then they would keep the loan, and they would make money from the fact that they borrowed money at a lower price, lower cost, and then they lent out at a higher rate, and they made that spread, and that was their business.
And they were on the nut because if it went bad, they held it. Those days are gone.
So they were incented to make good loans. Only lend money to people who can pay you back. Isn't that a novel concept? And now it really is a novel
That's not the game anymore.
No, because banks generate fees by making loans and then packaging those loans into bonds and selling the bonds to gullible pension funds and bond funds. And so you've got all these Fannie Mae and Freddie Mac bonds out there that never should have existed in the first place, but are really polluting the financial system. And so the CLOs are just the latest in a long line of stuff that shouldn't exist in the first place and is now causing trouble. So yeah, the banks have made these loans and sold a lot of them. So the problem is somebody else's, but they've had to hold on to some, and so the ones that are still on their balance sheets are causing them a lot of trouble now because they're going bad at an accelerating rate. The percentage of CLOs, or the percentage of bonds and loans in the sector that are non-performing now is starting to spike. It's been going down for the past 5 or 6 years, and now it's going up again. And history says that when that kind of a turn takes place, that the non-performing loan ratio goes through the roof. It doesn't just go up a percentage point or two. It goes up 5 or 6 or 7 or 8%. And your viewers who have seen the movie The Big Short will remember that happened for the housing market when mortgage defaults started to go up, and all the bankers were saying, oh yeah, we'll cap out at 5%. We'll see a little tick up in defaults, but that'll be it. And the hedge fund guys who were betting against the housing market were saying, not a chance. It's going to 8, 9, 10%. And they were right. And it'll be the same thing with these loans now, because we're going to see a wave of energy companies default in the year ahead. And a lot of those companies will have borrowed money from the big banks, which the big banks won't have adequately reserved for. So that means they're going to have to make massive write-offs of these loans going forward. And it's already starting. They're already increasing their loan loss reserves in these latest earnings reports. But they're just at the early stage of that. Historically, it takes a while for everybody to recognize a reality that is much worse than they expected. And so the rest of 2016 and early 2017 will be that process of coming to grips with it. And by the end, the numbers are going to be frighteningly bad.
I just, in terms of how banks have changed, my offices are in an executive building, and the guy who owns the executive building kind of sauntered into my office the other day, plopped himself down at my conference table, and he said, "Gord, I need to talk to you." I thought I was going to get a rent increase, right? And he says to me, he says, "I'm troubled." He says, "I think you might be able to explain it because I can't explain it." Now, remember, this is a guy buys and sells and owns tremendous value real estate, like lots of money. So you'd think he'd understand finance, which he does. He says, "I got a young son." He says, "He works for me in the summers. He's going through college. He wants to buy a car. I'm trying to teach him the values in life about money and saving, and his mother also wants him to have some kind of decent car to go back and forth to college." So I said, "Okay, you buy a car and then you buy what you want, but I'm not financing it. You got to finance it. You got to pay for it out of your summer job, and you decide what you can afford." So he says, "I decided I better go along with him." And well, he did it. I wouldn't interfere. But at the end of the day, because I knew that somehow I'd have to guarantee even the loan and the clunker he was going to buy because of his earnings capability. But I wanted to teach him a lesson. So he says, we went out for the whole process. And the next thing I know, he's buying a $32,000 Mustang, brand new. And I didn't want to interfere because we went into the office and I just quietly sat there as a dad, due diligent dad. And he showed him my son how he could buy it, and he never asked my son how much money he makes, what he works in the summer. I know that he within one summer is going to default on this loan, and I'm not paying for it. I've been pretty clear with it. He says, but we went out of there, and he signed the deal, and he says, "I'm troubled that we did it, but I have a wife too." He says. So he says, but my son walked out with a brand new $32,000 Mustang, and there's no way that he'll ever pay, and nobody asked him, nobody cared. He says, how does anybody make money on this? It's just a crisis about to happen. And I said to him, well, the dealership doesn't own the loan, right? And he says, no. I says, the bank that took the loan doesn't own it. He says, well, likely not. So who owns the loan? Where is all that loan paper going? And everybody's passing it faster than he can get the keys to the Mustang. And I says, that's the issue. And you ready for this, John? This is what really made him get up and leave my office. I says, the owner of that lease, that loan is you. The United States government owns $1.1 trillion in car loans. And you say, how is that? Because the car loans in the United States right now, remember we bought GMAC when they hold automotive, which became Alley? Do you know who buys all the credit default or credit loan obligation CLOs for that? The U.S. government buys them all. So what happens when he returns his car? There's a problem. What happens when the residual values are no longer as high because we have so many used cars? We have another problem the same way. Well, when I told him, got into that, John, I lost him. I think he was going to sell the building. He started paying. I didn't mean to be long-winded, but this is how poorly structured our banking system is. Because it's like nobody has responsibility. Everybody's passed it to another sucker.
Well, that is the ultimate home for a lot of these loans is central banks and central governments, because we've already set that precedent where in Europe, for instance, they bought up all the good debt during their first couple of QE programs. And now they're working their way down through some really dicey paper. And same thing in Japan. It's hard to buy a government bond in Japan because the Bank of Japan has bought it all up. And so now the central banks, if they want to ease again, which they have to, have got to start buying increasingly crappy paper. In other words, lower rated loans. And it looks like they're doing that. They're buying equities and they're buying debt that is really perilously close to being junk. And the process isn't anywhere close to being done yet because, the global economy is rolling over again. U.S. industrial output just this morning was reported to be down for the sixth time in 7 months. So, and that's not out of character for the rest of the world. Europe is kind of flatlining and Japan isn't growing and China's got a credit crisis. So the central banks are just getting started here. And one of the ways that they'll lean against the coming downturn is by buying more and crappier debt going forward. So they're already, as you said, buying up auto loans in the U.S. and that's just the beginning. They'll be taking these CLOs.
John, they're the only ones buying the auto loans.
Yeah.
They're the U.S. government is the only one that's buying them. They can't sell them fast. Nobody else will touch them.
Yeah. And so we're reaching the point where governments are the buyer of last resort for almost any kind of financial paper that's out there. And Japan owns over half of the ETFs, the equity ETFs. Yeah.
So it's not loans; they're buying equity.
They're buying equities. The Swiss central bank is one of the biggest holders of Apple stock. This isn't brand new. It's been going on for a year or two now, and it's accelerating, or it will accelerate when the next downturn comes. And so it looks like the downturn is coming now. Bank earnings are tanking. Most other sectors are seeing lackluster to negative earnings year over year, and the U.S. manufacturing economy is contracting. So there's no growth driver out there anymore. So governments are going to have to either run massive new deficits going forward, or central banks are going to have to take their monetary experiments to the next level. And so in the next couple of years, we're going to see some amazing stuff. We're going to see some version of that debt jubilee that's been kicked around for such a long time. The government will borrow a whole bunch of money and give it to us one way or another, either through big tax cuts or massive infrastructure spending.
They're giving the youth credit cards effectively what it is to borrow to pay for substance. So they're passing out the money. John, I'm on record of saying that I believe you'll see eventually is the central banks guaranteeing collateral. So right now we're talking about the Bank of Japan buying ETFs. Well, when the market starts to collapse and starts to fail, the problem is the collateral gets worth less, and it's so highly leveraged that when you're collateral, you get what they call a margin call. A little simplistic in terms of equities, but it gets really sophisticated in the bond market, and et cetera. So they can't afford that. So they'll come in and guarantee the collateral at some level, including equity. I can see it coming.
So, Gord, for a government, this is such an attractive idea, though, because they don't have to spend any money.
They just say, here it is.
It didn't cost taxpayers a penny. We just guaranteed the loans for this.
Pledge that as the American government that we guarantee it. We'll print as much money as it takes.
Yeah.
So, so that could drag this on, right? Is that another form of kicking the can down the road?
This is going to go on for a while, and the end game is when we lose faith in the currencies that these guys are using to play these games. Because as long as the dollar and the euro and the yen are considered assets, valuable assets around the world, they can do this because they can print unlimited numbers of these things and just use them to prop up one sector after another and bail out one constituency right before the election. They can do that on any scale they want to, until we wise up and say, I don't think I want to hold these currencies anymore. And when I get paid, I'm going to convert that money into real assets. And so when enough people do that, that spikes the price of real assets. And then you get what manifests as inflation, but it's really a loss of confidence in the currency, and then everything falls apart. And that's the kind of thing that happens really quickly when it happens. Why Germany went from having a fairly stable currency to hyperinflation in a couple of years. And so around the world, we're taking big experimental steps that could easily lead in that direction and could take us there in a way that's uncontrollable once it starts. So the next few years are just going to be fascinating on so many levels and terrifying on most of those levels.
I looked at 52 cases of hyperinflation. And remember, hyperinflation is a currency event. It's not about inflation. It's about a lack of confidence in the currency. Mm-hmm. And of the 52, the longest was 6 months. They're very quick. Most of them were measured in weeks, 6, 10, 15 weeks. It's very abrupt, very startling, and maybe drag on for multiple months. But U.S. dollar may be longer, but it's violent. But that's what can be in store when there's a loss of confidence in the currency.
Yeah, because this is analogous to a stock market crash. Where all of a sudden nobody wants to hold tech stocks anymore, and in 6 months they go from the Nasdaq goes from 5,000 to 2,000. That's what could happen in the currency markets in the not too distant future. And the timing of that is completely unpredictable because we've never had a global currency bubble like this before. So we don't know how long it can go for, but it sure does feel like we've reached the limit of a lot of these policies. It looks like we have one more iteration of incredibly easy money, and then after that, it stops working and everything falls apart. So, it might go on for a couple more years, or it might happen later this year. There's no way to know. but it definitely feels like it's coming.
My gray hair have taught me one thing. Don't ever underestimate the ingenuity of central banks and governments to manipulate and deviously come up with strategies to save themselves. So I think there's more shocks that are coming that'll will stun us. John, so in wrapping here, what's the key message our listeners need to take away from your views on Q1 earnings?
Well, Q1 is kind of putting a period at the end of the expansion, because if the financial sector can't grow, the rest of the economy can't grow. And it definitely looks like the financial sector is done growing. So we'll look back on this as probably the beginning of the recession that causes all the changes we've talked about so far here. So this is an important quarter, and right now it's playing out according to script, and the script is very ugly.
John, we have to wrap. Can you tell our listeners how they could follow your work and your new podcast that you're doing, I believe, on a weekly basis now?
Yeah. I'm branching out into actual technology now, Greg. I run dollarclaps.com, so visit there. You'll see a lot of links that relate to what we talked about today, plus some links to the podcast that I'm doing.
So you don't have to wait once a month to hear what you have to say. You now can hear it on a weekly basis on a podcast, right?
Oh, my God. Yeah. Talk about overexposure.
But blow by blow as it unfolds. Anyway, John, have a good weekend, and we'll talk to you next month.
Yeah, thanks.
Thank you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.